Welcome to the Deep Dive, where we extract the core narrative from the noise of earnings season. Today, we're digging into the Q3 2025 earnings call for SoundThinking. That's ticker SSTI, which they held back on November 12th.
Yeah, and our mission today is really to get at one central question. Are these failures we're seeing just, bad bureaucratic timing, which is what management is claiming?
Right.
Or is their big, ambitious pivot to this comprehensive platform actually hurting their ability to execute on the core business?
Mm-hmm.
We really have to unpack a quarter that management, in their own words, called below expectations, and look at a guidance reset that basically wiped out a huge amount of near-term profit.
That tension you mentioned, timing versus a real structural failure, that's what this is all about. And the market reaction told the story pretty clearly. A double miss, a big guidance cut, and a stock that fell off a cliff. So let's just start with those headline numbers.
The numbers were weak. No way around it. Revenue came in at $25.1 million.
And the street was looking for what? Closer to 28?
Yeah, consensus was right around $27.7 to $27.9 million. So they missed by, call it 9%. And that's also a 4% decline year over year.
When you look at that 4% decline, you have to remember that last year's number had about $2.8 million from the Chicago contract.
Exactly. That contract is gone now.
So to still have a year-over-year decline, even with that easy comparison, that tells you they were really struggling on the top line. But the real alarm bells, for me, were on the profitability side.
Oh, absolutely. The GAAP net loss widened out to negative $2.2 million. And their adjusted EPS, which is their non-GAAP number, came in at a loss of 16 cents.
And analysts were only expecting, what, a 7-cent loss?
A 7-cent loss. So that's a massive 129% negative surprise on the bottom line. It's just a huge miss.
And it wasn't just the size of the loss, it was the margin compression that came with it. Adjusted EBITDA fell off a cliff.
It really did. It went from a pretty respectable 17% a year ago down to just 14%. In dollar terms, that's only $3.5 million.
So you have this combination of falling revenue and shrinking margins. That's the classic recipe for a stock sell-off.
It is. Investors see two things happening at once. The revenue isn't there, and the operational leverage is going in the wrong direction. It just makes you question the health of the whole business.
Management was, of course, quick to give a reason for all this. They pinned the entire miss on the timing and delay of 3 very specific, large, and importantly, high-margin contracts.
Right. They're saying it's a delay, not a cancellation.
But is the market buying that excuse?
Well, that's the big debate, isn't it? The CFO basically laid out this $6.4 million hole in expected revenue that just slipped out of 2025. And their whole argument is that this slippage is the direct cause of the guidance cut. If they'd hit that number, the quarter would have been fine.
Okay, so let's break down that $6.4 million hole, because each piece seems to have a different level of risk. What was the first deal?
The first one was a statewide CrimeTracer deal. They were expecting about $2.5 million from it. It's a contract to roll out the platform across 18 different agencies in a new state.
And the problem was just paperwork.
Pretty much. Bureaucracy, the funding is secure, the money is there, but it's all hung up in these, complex multi-agency procurement processes.
So that sounds like a genuine timing issue, just classic friction when you're selling to the government.
Exactly. It's an administrative delay.
Yeah.
Annoying, but probably low risk of actually being canceled. But the second piece was international. This was a capital expenditure deployment in Brazil for their ShotSpotter tech, also worth about $2.5 million.
Okay, and what was the holdup in Brazil?
That one's a bit more worrying. They pinned it on recent governmental changes and some unexpected tariff impacts. It's made the timing totally uncertain.
So that sounds less like a delay and more like, a structural problem. They're basically admitting they misjudged the political risk.
It definitely raises the risk profile. If you're waiting for political clarity, that $2.5 million could be pushed out indefinitely. But the third deal, that's where the story gets really interesting. It's the Puerto Rico ShotSpotter renewal, expected at $1.4 million.
This is where that narrative of delay starts to fall apart, isn't it?
It is. The delay was also tied to governmental changes, but here's the critical difference. Management confirmed the ShotSpotter system in Puerto Rico has been turned off.
Turned off, so they're not getting paid.
Not getting paid. And crucially, they said that historically, Puerto Rico doesn't backtake contracts. So any revenue from the period the system was off is just gone. It's not delayed. It's lost revenue for 2025.
And the analysts on the call jumped all over the margin impact of this. Management said 70% of that $6.4 million would have flowed straight to adjusted EBITDA. How is that possible? How is the margin that high?
This is the absolute key to understanding the pain of this quarter. Those specific deals that got delayed carry way higher margins than their average business. A renewal like Puerto Rico, for instance, is almost pure high-margin SaaS revenue. The system's already deployed, so the renewal is almost all profit.
So if 70 cents of every one of those delayed dollars was profit, that must mean the revenue they did recognize, that $25.1 million, had a much, much lower margin.
Precisely. The math implies that their core day-to-day business of selling and installing hardware has a pretty tough margin structure. It shows how reliant they are on these big high-margin software and renewal deals to hit their profit targets. When one of those slips, the whole model looks shaky.
So the missing deals didn't just hurt the numbers, they sort of exposed a weakness across the rest of the business.
Exactly. That's why an $8 million revenue guide cut turned into an almost identical $8 million cut to their implied EBITDA for the year. The revenue they lost was all the good revenue.
And all of this sort of forced management's hand. They had to admit a deeper problem, that this big pivot to their new SafetySmart platform was actually confusing their own sales team.
Yeah, they spent a lot of time on the call talking about that pivot. And it's crucial for them long term. They pointed to the launch of CrimeTracer Gen3 in October as a really big deal. This new version has voice-enabled search, AI, to summarize reports. Stuff like that.
And why is that so important? It's more than just a software update, right?
Oh, yeah. It dramatically expands who can use it inside a police department. Before, CrimeTracer was really a tool for detectives and analysts. Now, with voice search and AI summaries, a regular patrol officer can use it on the street to get quick intelligence. It goes from a niche tool to an everyday platform.
That makes sense. They're trying to sell more seats to the same customer. And they also talked about huge momentum for SafePointe, their weapons detection system.
SafePointe is their bright spot, for sure, especially with California's AB 2975 mandate, which is forcing hospitals to install weapons detection systems by early 2027.
A mandated market? That's going to be a great tailwind.
It is. And they just won a big deal, a 26-lane opportunity at a hospital in Florida. So it shows the demand is there outside of California, too.
So on one hand, you have these great new products, a huge mandated market opportunity, but on the other, they admit to sales execution challenges. It's a bit of an irony.
A huge irony. The CEO basically said they weren't where they needed to be. They were trying to get their sales team to be more consultative, which meant pitching the whole grand vision of the SafetySmart platform right away.
Which probably just confused customers who only wanted one thing.
Exactly. It added months to an already long sales process. So now they're completely realigning the sales team, bringing in an interim SVP, and going back to what they call a point execution playbook.
Fewer things in the bag.
Fewer things in the bag. Just sell the customer what they need right now. They talked about how SafePointe for a hospital is a faster sale, maybe 12 months, but ShotSpotter for a city can take 18 months or more because of politics. They realized they were confusing those two sales motions.
But, despite all this pain, you can't ignore some of the good news. The core business seems to be pretty solid.
It really does. Their Net Promoter Score, or NPS, which is a measure of customer satisfaction, actually rose from 66 to 70.
And a 70 is considered world-class.
It is. Retention is also strong. And they're still deploying new systems to new cities, a university, a couple of expansions. The customers they have are happy, and they are staying.
Okay, let's switch to the guidance, because this is where the real tension is. The 2025 reset was brutal.
Oh, it was a brutal cut. They took full-year revenue down from the $111 to $113 million range to just about $104 million.
And the margin guide was even worse.
It was almost cut in half.
Yeah.
Adjusted EBITDA margin went from 22% all the way down to 15%. And they said Q4 would be pretty flat with Q3, so no quick recovery there.
It feels like they were trying to de-risk the rest of the year completely, but then almost in the next breath, they pivoted to this really bullish 2026 outlook. How do they maintain credibility there?
That is the million-dollar question. That's the credibility gap. They're asking investors to just forget about the 2025 execution failures and trust the long-term vision. They introduced fiscal 2026 guidance for revenue of $114 to $116 million and an EBITDA margin of 18-20%.
And they stood by those really ambitious long-term targets, right? Something like 70% gross margins and a 40% adjusted EBITDA margin. I mean, if you can't even execute on a few secure deals today, how do you have any confidence in hitting 40% operating leverage in a few years?
Their whole defense rests on one word: scale.
Yeah.
They argue that once they get past this rough patch, the high-margin new products will kick in, and the fixed costs will get absorbed, and margins will just explode higher.
A classic software scale story.
Exactly. It relies on the stickiness of ShotSpotter and the pure software margins of things like CrimeTracer Gen3.
Speaking of stickiness, we also got a pretty important update on the Chicago contract.
We did. The RFP process there is finally getting close to the end. They did a live fire demo back in September. And the most encouraging sign for investors is that the mayor's 2026 budget proposal has a specific line item for acoustic gunshot detection. The police superintendent is also on board. It looks very likely to happen.
So if you're an investor looking at this now, you've got this complete divergence, terrible 2025 execution, but happy customers, new products, and this huge long-term goal.
And the market is voting with its feet. It's focusing only on the 2025 miss and profitability cut. Investors are totally ignoring the high NPS score and the 2026 story. They're just punishing the near-term failure to close deals.
All right, it's time for our segment. This is not financial advice. We're just synthesizing all this data to a theoretical trade idea. We're not telling you what to do, just presenting an outrageous but plausible bet.
Okay, so the stock has been hammered, right? The market has priced 2025 as a total write-off. But management is sticking to their story that this is a timing issue, not a demand issue.
So the outrageously plausible trade idea here is to actually initiate a small, high-conviction long position in SSTI. Think of it as a short-term catalyst trade, maybe a 12-month horizon.
And the rationale is pretty simple. You're betting that the market has completely overreacted to the temporary delay of those high-functioning contracts. The whole bet is that management can reestablish its credibility in the first part of 2026.
So if that Puerto Rico renewal gets signed and that big statewide CrimeTracer deal finally closes, say, in Q1 of 2026,
the company would have a massive, very visible beat on both revenue and EBITDA. It would instantly make that 2026 guidance look credible and start to close the gap toward that big 40% long-term margin target.
You're betting that these bureaucratic logjams are just slow, not fatal, and you use this post-earnings drop as your entry point for a relief rally.
That's the trade.
So, to wrap this all up, SoundThinking is facing a huge execution year. The 2025 reset is forcing them back to basics on their sales strategy, but their platform investments, like CrimeTracer Gen3 and SafePointe, they look really promising, and their customers are clearly very loyal. The stock is just reflecting their inability to turn that strong pipeline into cash quickly enough.
And the key takeaway for you, the investor, really comes down to that central question we started with. You have to decide if the company's platform story is powerful enough to overcome the politics and bureaucracy that are just part of selling to the public sector.
Right. Or will these persistent contract delays keep happening? Will the story shift from a platform transition to just being a frustrating value trap? And the answer to that question is what's going to define this stock's performance through 2026.